Corporations. So some of the general characteristics of corporations. Corporation functions as a unique entity in and of itself, almost like a human being would function as far as legal and accounting purposes go. There's a couple different ways to classify corporations: by purpose or by ownership. By purpose would mean, is it a for-profit corporation or a not-for-profit corporation? By ownership would mean, are the shares of stock traded publicly, or is it a privately held corporation where you basically have to know one of the owners or be a family member or some other way of investing and being able to buy stock. Some more characteristics. Generally, unlike partnerships, stockholders who are the owners of the corporation have limited liability. Um, Essentially, they're generally only limited to their investment or the stock that they own. Um, Ownership rights are transferable, so owning a share of the company generally allows you to buy and sell other shares. Continuous life, so that if ownership changes hands, the corporation doesn't cease to exist. And obviously, the ability to sell stock grants you the ability to acquire capital. So this is just a basic structure of a corporation. You have at the top stockholders, who are the owners of the corporation, and then they elect a board of directors and a chairman. And the board of directors and chairman then hires a CEO, and then generally the CEO is in charge of hiring and basically running the company, hiring the other C-level officers, which are generally vice presidents or executive vice presidents. A few examples there: chief financial officer, chief operating officer, chief marketing officer, chief technological officer, or chief technology officer, chief legal officer. And there could be more or less C-level officers than that. Under the CFO, for accounting purposes, there's generally a treasury and controller entities, usually headed by one or more people. And so that's, for accounting purposes, this is basically the hierarchy of power and structure of a corporation. So some of the disadvantages of corporations: the biggest one is double taxation. So since the corporation exists in and of itself, the actual corporate entity is taxed on its own. And then if the owners, the stockholders, receive dividends from the corporation, those are taxed at the individual level as well. So money that the corporation makes is being taxed at the corporate level, and then again when it flows out to the owners. So that's why it's double taxation. Obviously, anytime you have a governmental entity like a corporation, there's more hoops to jump through as far as governmental regulations go. And then separation of ownership and management basically just creates sometimes some conflict in the individual interests of owners versus management. And the corporate charter and the bylaws generally are set up to try to minimize those, but it's an imperfect system, so there's generally always some different conflicts of interest there. In order to form a corporation, you're basically doing it under one state's individual state laws. So a lot of corporations will look at the different state laws of the different states and decide which one is the most favorable for them. Most laws, state laws governing corporations, do not require the corporation to actually be housed in that state to form it there. So it's very easy to shop around and pick the best laws to go with what you're doing with your corporation. So once you apply to a state to become a corporation, the state grants a charter, and you have bylaws that kind of set out the basic functions of the corporation, how to take care of the day-to-day operations, how often there will be, how often and when voting will take place, how to change the board of directors, basically the ins and outs of running the corporation. And then, that's separate from operations. And of course, wherever the corporation is operating, they'll have to go out and get a business license from each state where they do business. Obviously, it costs money to form a corporation. Any money that goes into legal fees, the fees from the government for forming, anything that goes into the organization of the entity is considered an organizational expense, and these are generally expensed as incurred, which means they're not capitalized, so the expenses are recognized immediately. Obviously, the purpose of selling stock, and one of the big purposes of forming a corporation, is to be able to generate more capital for your business, whether this is just to start out the business, to grow it to a bigger level, or go nationwide, or whatever the case may be. Generally, when you apply to become a corporation, you're having to kind of anticipate the amount of stock that you're going to want to sell, and the charter that you receive upon formation sets out the authorized amount of shares of stock that you can sell. And these shares can either have an initial value called a par value that's set out in stone, or not. It could just have no par value. But the authorization of stock does not constitute an accounting event, because that's just basically permission to sell a certain amount of shares. So back in the older days, anyone who bought stock had stock certificates. Obviously, most stuff is done online these days, but the underlying original stock in each company has a corresponding stock certificate that sets out par value and whether there's any other special rights if it's preferred stock. We talked about articles of incorporation and bylaws kind of determine the rights of shareholders and how the housekeeping of the corporation is going to work. And the initial issuance of stock and further issuance after that is usually done one of two ways, either directly to the public or through a middleman, which is called an investment bank. So in that case, an investment bank would buy up all the shares, and then they would go out and individually market those shares. And usually, obviously, they would try to market them for more money, and that's where they would make all their money from. So under when we're looking at the basic accounting equation, under the owner's equity section, there's two sections of corporate capital. One is paid in or contributed capital, and the other is retained earnings. Within the paid in capital category, it lists out however many different varieties or categories of stock that you have. If you only have the one category, it's usually just an account called common stock. And then retained earnings is going to be the closing entry from the income summary. So basically, whatever money you've earned or lost through operations flows over into the retained earnings. Okay, so moving into the actual accounting for issuance of stock. So if you have par value stock, then let's assume that you're selling 1,000 shares for $1. It's $1 par value, and you're selling them for $1 each. So that first entry there, if sold at par value, you would debit cash for 1,000 and credit common stock for 1,000. Okay, when you're entering the entry into common stock, whenever you have par value stock, that entry to common stock is always going to be whatever the par value is. So if you look down at the next line, if stock is sold above par, so the same situation, you have 1,000 shares, $1 par value stock, but now it's sold for $4 a share, then obviously the cash you're getting is $4,000. We still have that same credit entry to common stock for 1,000 because that reflects the par value of the stock, and then whatever the difference is between the par value and what we actually received goes into an account called paid in capital in excess of par, and that's where you see that credit entry for 3,000 there. So again, there's, if you have par value, you can either sell it for par value, above par value, and then the last remaining option is below par value. So as long as other stock has been sold already in the company above par value and you have a credit balance in the account paid in capital in excess of par. Then if stock is sold below par value, so assuming we sell another 1,000 shares of $1 par value stock, but now we're selling them for 75 cents a share, then we debit cash for the amount we received. So 75 cents times 1,000 shares is $750. And then again, that credit to common stock is going to be for the par value. But now we have a deficit on the debit side. So we're going to debit that paid-in capital in excess of par for $250. Okay, but again, that can only happen if there is a balance in paid-in capital in excess of par. In other words, that account paid-in capital in excess of par can never have a debit balance. So it can never go into the negative. As soon as it goes down to zero, then we go over to the second option, which is basically the same thing, except instead of paid-in capital in excess of par, since there's no balance left in that, we have to debit that difference there, that $250, from retained earnings. So the easiest entry to do when accounting for common stock is when there's no par value or stated value. If there's a stated value, that functions exactly the same way as par value. The only difference is instead of saying paid in capital in excess of par, you say paid in capital in excess of stated value. But otherwise, it functions exactly the same way. Now, if there is no par value or stated value of the stock, then all you're doing is entering cash for the amount, debit to cash for the amount that you're receiving, and credit to common stock for that same amount. So if we sell 1,000 shares of stock for $20 a share, but there's no par value, the journal entry is $20,000 of cash debit, and then $20,000 credit to common stock. So we also have the option of issuing common stock for services or other types of non-cash assets like property. When this happens, you're essentially just following the same rules. If it's par value, then you still are recording it the same way. The only difference is instead of receiving cash, you're receiving something that has a cash value. And so it's your job to then go in and find out what that cash value is. So if it's, let's say it's a piece of equipment. So instead of debiting cash, you would debit the equipment asset account. And the amount there would be, following the cost principle, it would either be the value of the consideration given, so the value of the stock that you're giving, or the value of the equipment that you're receiving, whichever one is a more reliable number. So whichever one you can most easily determine. So if this is the initial sale of stock, you may not know what the value of that stock is. So if it's not openly being traded, there's no real marketplace value, so you'd have to guess at that. But maybe the equipment that they're giving you has a very set in stone value. You know exactly how much it would cost if you were buying it for cash, so that might be the easier way to go. But maybe the piece of equipment, you know, it's hard to determine exactly what the value is, but you have a bunch of stock out there already that's trading for a certain amount of money. So if it's trading for money, you know exactly what the value of that stock is at any given time. So whichever one of those is most easily determined, that's the amount that you're going to debit to the equipment account, and then obviously you would do the credit to common stock for whatever the par value is, if there is one, and then, you know, if it's above par value, then a credit to paid-in capital in excess of par. So treasury stock is basically when a corporation has issued a bunch of stock and it goes in and buys some of the stock back from individual stockholders. Okay, so let's assume that we bought back $50,000 worth of stock. So it would be a debit to treasury stock for $50,000 and then a credit to cash for $50,000. That's the journal entry for the corporation. Treasury stock is considered a contra capital account on the balance sheet. So you know, at the bottom of your owner's capital section of the balance sheet, you know, you'd get to a bottom line number, and then you would subtract however much treasury stock has been purchased, and that would give you your bottom line balance there. So then when you go back in and sell that treasury stock, so let's say that in this situation, this first journal entry, we purchased, um, let's say we purchased 1,000 shares of stock back from the shareholders for $15 a share. So the balance is $15,000 in treasury stock debit. So now we're going to sell that $15,000 worth of treasury stock, but the value has gone up, so we're going to receive $20,000 for it. So this functions very similarly to par value. So the value is established when we bought it from the shareholders at $15,000 for that amount of stock, and that's what we're going to credit to the treasury stock account. So that will zero it out. The debit to cash obviously shows how much cash we're getting, and then this credit to balance the entry shows the paid-in capital from treasury stock. Basically, the exact same thing as paid-in capital in excess of par, but since the treasury stock, we're not worried about par value, we're just worried about the value we paid for it. This is essentially paid-in capital in excess of what we paid for the treasury stock. Okay, and same thing holds true on the other side. If we sell it for a loss, it functions the same way as having a paid-in capital account. If there's a balance in that paid-in from treasury stock account, then we can use that as the debit portion of this entry. If not, then you have to debit retained earnings for whatever the loss is going to be. Okay, and the other category of stock that we're going to talk about a little bit is preferred stock. And basically, preferred stock usually has a percent attached to it. So if it's, say, 10% preferred stock, that would mean that whatever the par value of that stock is, so let's say it's $10 a share and it's 10% stock, that would mean that every year that dividends are declared, each one of those shareholders receives 10% of the value of their stock, the par value of their stock as a dividend. Okay, so some characteristics of preferred stock are that if dividends are declared and paid, the preferred stockholders have to receive theirs before any common stockholders get theirs. So there's a preference there. And then again, if the corporation is liquidated and there's not enough assets to go around to pay all of the stockholders what they're owed, the preferred stockholders will get paid first. And then this is just an example of what the shareholders' equity section of the balance sheet might look like with some of these various accounts.